Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, we have Kevin Mahn. He's the Chief Investment Officer at Hennion and Walsh and Smart Trust UITs. And we're going to take a look at different investment areas in a low interest environment. We have a lot to get through.
Yes, we do.
And again, going in that slowing but growing theme that you've been on, over the past year. Looks like you're going to dividend growers at this point.
Yeah, I think if you look at what the Fed did in October, and I still contend they didn't need to cut interest rates in October, they didn't need to cut interest rates in September, given their dual mandate of promoting full employment and stable prices, both of which have been achieved. But regardless, that type of dovish posture, in addition to the strength of the U.S. consumer, should bode well for stocks for the remainder of this year and through the first quarter of next year. One area that we like a lot, Jill, and you just touched upon it, is dividend stocks, particularly those companies that have been growing their dividends over time. There's a study from the Hartford funds which actually shows that over time, dividend growers or initiators tend to outperform non-dividend growers or companies that don't pay a dividend and with less risk. So I think that's one area of the market that investors may want to consider.
What about combining multiple asset classes for income potential?
Yeah, I mean, even today we see yields rising because people are moving from fixed income into equities, given the record highs we're reaching. There's still some other areas that may pay more attractive levels of income, whether it's municipal bonds, preferred securities, convertible bonds, dividend paying equities, as we discuss. So I think investors need to look beyond traditional sources of income and consider some of these other areas as well.
All right, now what about muni bonds?
Yeah, muni bonds. Boy, I tell you, the current 10-year municipal to treasury yield ratio is at the highest it's been in a year and a half. So that suggests that municipals are now more valuable relative to treasuries. And we still have increasing demand for tax-free income, whether it's from high net worth individuals in states such as New York, New Jersey, California, or just investors looking for a higher yield than what the actual yield curve is providing. And we've seen that mutual fund flows. 43 consecutive weeks of inflows going into municipal funds. So we think that's one area that's going to continue to be an area of attraction for investors, not just for the fourth quarter, but all the way through next year and beyond.
All right, now biotech stocks. This is the first time you and I have spoken about this.
Biotech is certainly starting to heat up again. We've had 16 major biotech M&A announcements thus far in 2019. We heard recently that Biogen is starting to put their Alzheimer's drug back in the queue for FDA approval, a potentially groundbreaking Alzheimer's drug. And we think large pharmaceutical companies are going to need to acquire smaller cap biotech companies to maintain their profit margin and also to deal with potentially lower drug prices in the future. So that's one area that investors may want to look at.
Let's go back to the slowing but growing theme that you've been on. And this has always been, in terms of the economy, but we see domestically and what we see globally. When we think about slowing growth, let's talk about earnings here.
Yeah.
CapEx is down a lot.
CapEx is down a lot.
That doesn't set up for future growth. That's a concern.
It's definitely a concern. And if you compare it to 2018, we are well below where we were in terms of earnings and economic growth last year. But we still have GDP growing at 2% or above. Even for the third quarter, we saw roughly 80% of companies beat their earnings estimate. Granted, they were revised downward, and over 60% of companies beat revenue estimates. And what that speaks to me is that the underlying U.S. consumer is still relatively confident, especially with an unemployment rate of 3.6%. If they remain confident and 70% of GDP comes from the consumer, well, then a record holiday shopping season, which I'm forecasting, should bode well for the economy.
And we also have seasonality coming into November and December as well.
Absolutely true.
All right. Well, Kevin, thanks so much for joining us as always at MarketSite.
Thank you, Jill.
And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.